Okay, let's take a look at what's happening with those U.S. futures. Softer this morning as we yesterday kicked off a new month of trading after what's been a pretty momentous run for the S&P 500, 5 straight months of gains. The TSX coming into August, it's 2 months of advances. And yes, we've been digesting interest rate talk and earnings, certainly. And now we've got this other conversation piece, the U.S. being stripped of its top-tier sovereign credit rating by Fitch. I want to put all of this in context with our first guest this morning, Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Middle of summer, no shortage of things that we need to run around talking about right now.
Maybe they were bored and they decided to come up with a headline because really it's a head scratcher.
Well, okay, why do you say that?
Because what is the reason? The economic data that is coming in is okay. The markets are doing okay. Rates are normalizing. Employment is full. The economic situation is good. Earnings are a little light, but better than expected. Markets pricing in climbing walls of worry. Why now?
I mean, there are 3 main things Fitch seems to be saying. First of all, they're pointing to the overall debt load of the United States, which is a big one. This does seem to be a follow on the worries that were surfacing not that long ago when we were talking about the possible U.S. debt default. And even Fitch at that time was sort of hinting at a possible move. So it seems like that standoff rattled them to a certain degree. And then the idea of this recessionary risk. But to your point, the idea of a recession is even receiving pushback, not just from Wall Street this morning with Bank of America, but even the Fed itself.
Yeah. I think there was also another element that had to do with governance. I read it in the fine lines, not so much being brought forward. And when I was in the office this morning going through all the trader chat rooms, there was not one mention of the U.S. debt downgrade. It was all business as usual, stocks and markets. The governance, I understand the governance. This was almost like, I feel like a bit of a slap and saying, you know, get your house together. We have Trump being indicted again. You know, there's a lot of unsavory political headlines going on in the U.S. in the last little while.
I mean, on that level, kind of interesting to see them saying, hey, your political squabbling, it's frustrating us, and we're going to let you know about it.
Yeah.
I think for the markets, to your point about people focusing on other things, this is generating headlines. I do wonder if people who had watched the market rally so substantially this year, maybe we're starting to look for a reason to hit the sell button, at least in the short term.
Yeah, you have to look at how the market digests things. It's telling you what it wants to do. And, you know, futures are off the lows and the 10-year yield is still just at 4%.
Yeah.
Dollar's not really reacting. Yes, we've coming into a market that, to your point, when you started this segment, is already up so much. And we're going into a seasonally quiet period. You know, maybe we've gone up a bit too much. And you know, I allow for a little bit of volatility come August, September. But the markets are doing the good lifting work, and breadth is expanding, and hopefully that's going to carry through to the TSX a little bit so we can catch up a little bit.
Well, I do want to talk about that. Now, before we dig into the Canada versus U.S. story, our Bloomberg colleagues had a fascinating stat this morning that we've gone something like 47 trading sessions with the S&P 500 without seeing a decline of more than 1%. And over that period, I think we've seen a couple of Fed decisions, we've seen a couple of jobs reports, we've seen a couple of inflation reports. So maybe I should be asking the question the other way. What is it that would break the momentum for the markets at this point?
So nothing obvious. I think there is a couple of things that could play into it. So I'm of the view that rates at this level are actually beneficial, and I hope they stay this way. And I hope they never cut rates, because I don't think that would mean something's wrong. I think we're normalizing rates from the great financial crisis. 0 rates is not good. It doesn't differentiate between good and bad projects. So now we're getting back to normal. The other thing that's going on in the background is what's happening in Japan and their yield curve control. There's been a big trade going on for the last 20, 30 years, which is the carry trade. And if Japan is finally starting to see some inflation, which they would love to see, and Bank of Japan lets go of their yield curve control, because they've been buying their bonds to keep the yield down. If they let go of that, that means that money is going to flow out of the rest of the world back into Japan, and so that might impact markets a little bit. But long term, it's earnings and it's economies. So once we get through that volatility, if we hit that roadblock, if and when, we'll see some volatility. But as long as the economies hold the data that we've been seeing I couldn't come up with a better set of data. The pricing data is coming down and the demand data is holding in. So employment is key here. As long as people have jobs, they can pay the mortgages that are now much higher than they were before.
They surely are.